Well, adjustable rate mortgages, which fell out of favor in the aftermath of the financial crisis, are catching on again. Here with the story is senior housing reporter Claire Boston. So Claire, to start here, what exactly is an adjustable rate mortgage?
Hi, Allie. So as the name suggests, an adjustable rate mortgage, the interest rate can change over time. Typically these days, you get either a 5, 7, or 10-year period where you have a fixed rate on your mortgage. And then after that period expires, if you're still holding that mortgage, the rate will start to adjust based on the prevailing market rate. So that means it could go higher, it could go lower. In exchange for taking on that extra interest rate risk, you can often get a lower rate than what is available with a 30-year fixed. Right now, 30-year fixed rates are 6.3, 6.4%. Adjustable rate mortgages will be around 5.8% for that 7 or 10-year period. So there's savings there if you're willing to kind of stomach that risk.
And you say that these types of mortgages are catching on. Where is that showing up in the data? How do you gauge the popularity?
Definitely. So the Mortgage Bankers Association keeps data on market share and how much these mortgages are being used. A couple weeks ago, we hit a post-crisis high of about 13% ARMs. This past week, it fell a little bit to about 9%. That being said, in some years, we've seen as little as 1% ARMs being used. They really fell out of favor after the crisis, but they're coming back now. And from what I hear, it's because people are really looking to get those lower rates, and ARMs are a way to do that.
And you said they're coming back into vogue again after what we saw with the boom and bust housing market, the 2008 financial crisis. How are today's ARMs different?
Definitely. People are pretty scared of ARMs because they just remember something happened with them in 2008. Basically, back then, ARMs could adjust as frequently as once a month when you were in that adjustment period. These days, the adjustment period typically lasts 6 months or a year, so you don't get those surprises. You know what your rate is going to be for a little bit of a longer term. It's also really hard to qualify for an ARM. You have to be a very highly qualified buyer. You're going to need a good credit score, a good down payment, and the income that shows that you will be able to pay your mortgage even if your interest rate does rise. And that really wasn't the case in 2008, but things have changed since then. And
how closely are these mortgages tied to the federal funds rate, especially since we know the Fed has started its easing process?
Yeah, we talk all the time on here about how when you have that 30-year fixed rate mortgage, it is not directly tied to what the Fed is doing. But ARMs are a little bit different because when you're in that adjustment period, you are tied to something called SOFR. And SOFR is very closely linked to the federal funds rate. And so if the Fed starts easing and you're in that adjustment period and SOFR falls, you may actually see your mortgage rate go down. It's a little early to tell, what is going to happen this time around, but the Fed did just cut. They say they may cut a few more times, and that means that as an ARM in an adjustment period adjusts, there could be a little bit of rate savings for those borrowers.
All right, we'll see what the Fed ultimately decides to do. Claire, thank you so much for joining us as always.
Thanks, Allie.
And for more mortgage content from Yahoo Finance, scan the QR code below.